Michael Kurtz, Chief Asian Equity Strategist with Nomura, joins us live from Hong Kong via Skype. Michael, good morning and fantastic to have you back on ET Now. Michael, fears of what Fed could do in the month of September has led to a synchronized sell-off in emerging markets. Do you think the fear of tapering is slightly overdone?
You know, I don't think that the tapering fears are overdone in the market, but I also believe that there's more to this volatility than just Fed tapering. The real issue is that U.S. Treasury yields have gotten substantially higher, and that creates problems for the emerging markets, either that have been running substantial current account deficits or budget deficits. India, for example, famously having a twin deficit problem. Indonesia is in similar situation in terms of its budget and its external balances. But then it also creates problems for the emerging markets that have been, let's say where their bond markets or their equity markets have been fueled by very cheap dollar funding, what we call carry trades. And now as Treasury yields move higher, unfortunately, it's making the funding of those deficits or the funding of those carry trades more expensive. And so those positions are unwinding. But it's not only about the Fed. It's about the fact that U.S. growth does appear to be on the mend. And the simple fact of stronger U.S. growth means that Treasury yields should be going higher. The Fed is really simply responding to the fact that growth is coming back. And that's good for some emerging markets. Unfortunately, as we're seeing, it's a bit of a challenge for others.
Michael, hi, morning. The currency has never been as fragile. It's already depreciated a good 20% since the start of the year. How do you see global and domestic forces guiding the rupee ahead with every psychological mark getting breached? We breached 66 to the dollar yesterday.
Indeed. And unfortunately, I think India really does stand out as being perhaps in the worst position amongst the large Asia-Pacific emerging markets. In terms of its external situation. We have this problem in India where external funding for your current account deficit becomes much less willing at a time when foreign investors are able to get better yields without having necessarily to go into the sort of exotic space of emerging markets, or what a foreign investor, for example, based in Boston or New York or London might consider an exotic market such as India. And as a result, India is faced with a situation in which now its currency either has to decline or the Reserve Bank has to build a much stronger support underneath the rupee by hiking domestic interest rates in India. And clearly this is a time when either for political reasons because of the election calendar in India over the next 12 months or because of the upcoming change at the governorship of the RBI, there's much less willingness to move ahead forcefully. And markets are responding, of course, by pushing the value of the rupee much lower. Unfortunately, if I may elaborate, this brings in certain second-round effects. A weaker rupee then creates even more domestic inflation, and that causes foreign investors to become even more cautious on the market. Then you see more money coming out and more pressure on the rupee in a kind of a reinforcing vicious cycle, if you will.
Michael, but the reverse end of the argument is that Indian currency will also get competitive because of depreciation, and if the currency gets more competitive, export will pick up and eventual demand of imports will come down.
That's a perfectly valid argument, but unfortunately, of course, as we know, exports are not a particularly large component of India's GDP. In fact, India has the lowest trade to GDP ratio of all of the Asia-Pacific economies. Now, that speaks on some level to the strength of India's domestic economy. And certainly we can say that India has a much more well-developed domestic demand to GDP ratio, for example, than China, which is in desperate need of raising domestic consumption. But unfortunately, that means that the pass-through from a weaker currency into broader economic activity will be fairly narrow and fairly limited, while at the same time, of course, the inflationary effect of a weaker rupee will be much more broad in terms of how it impacts Indian households and Indian companies. When we think about the stock market in particular, one of our concerns is that currency weakness in markets like India or Indonesia will translate into reduced profit margin for corporates because you're going to see a rise in input costs that will ultimately become profitability negative for them. And again, that we think may keep the pressure on these markets over the near to medium term.
Michael, but somewhere do you think markets are pricing in too much of good news when it comes to U.S. economy? U.S. economy has not recovered. Street is divided on what the effects of quantitative easing are. And in the month of September, we know that U.S. politicians, they will be at loggerheads and they would try to really tackle with the problem of fiscal cliff.
Yeah, I think you're asking a very important question. We could make the case, perhaps, that markets have not really fully discounted the risks of another fiscal standoff in Washington. I do believe that both the Obama White House and the Republican opposition do not see any particular political advantage at this point in time in pursuing a kind of a cliffhanger outcome. I think there's more motivation to seek some kind of a compromise on the U.S. budget. But even as I say that, it doesn't appear to us that any of that risk is currently priced into the market. But in terms of the strength of U.S. growth, we believe that in nominal growth terms, that U.S. GDP will be back to about 3.4% in the first quarter of 2014. Now, nominal GDP growth of 3.4% is perfectly consistent with Treasury yields in the neighborhood of 3 or slightly higher than 3. And therefore, we don't believe, for example, that the Treasury market or the yield curve in the U.S. is being overly optimistic about growth. If anything, what we're seeing is a heavily suppressed yield environment in the U.S. finally unwinding as the market begins to anticipate that the Fed's extraordinary medicine will no longer be necessary.